Welcome, everyone. Thank you for joining us today on our Batten Down the Hatches Loan Restructuring webinar. We will go ahead and get started at 1 o'clock on the dot, so in about another minute here, we'll get started, so please bear with us. Welcome and thanks for joining us. All right, good afternoon, everyone. Thank you again for joining us today on our webinar, Batten Down the Hatches Loan Restructuring. We'll go ahead and get started. It's 1 o'clock now, so again, welcome and thanks for being here and spending some time with us today. With the entire globe dealing with the coronavirus, we are in uncharted territory. Humanity has, of course, seen other profound events, but what we are living through now is unprecedented in modern times. Not many people, if any at all, have experienced anything like this. The economic impact of COVID-19 is devastating for so many of us, particularly those of us that live in low income and low wealth communities. Individuals and families are experiencing deep, shocking effects as small businesses are closing, and some of them are closing indefinitely. Our CDFI industry is also going through these unprecedented times, which is why we are providing this webinar today, focusing on batting down the hatches, loan restructuring, and we are going to be talking with some of the best Native CDFIs in existence on what they are working on in their organization at this time. All right, just a few housekeeping tips before we get started. If you have any questions during this presentation, please feel free to type them into the chat box that you have available there in your Zoom control panel. Also, if you have any questions, we will mute everybody at this point just to keep all the distraction and background noise, have that all done, so we don't have to worry about that. But if you do have a question, please feel free to either raise your hand or go ahead and type into the chat box. If you do have a question, we can unmute you and you can ask that question out loud, or if you'd like to just send it over via chat, we can take it that way as well. And we will have a time at the end of the webinar to answer all of your questions that you may have for our amazing panel today. So thank you again for being here. With that said, we want to know, which organization are you representing today? I know we have quite a few folks signed up for this webinar, which really goes to show what a great need there is for loan restructuring in the CDFI industry at this unprecedented time. So we want to know, who are you representing? Where are you representing? What organization? Just type into your chat box who you are and who you're representing. And welcome. We are so glad to have you all here. All right, we have Niji Capital Partners. Hi. Okay, Team Oweesta, always supporting each other. Love it. Pam, so glad to have you here. Native American Development Corp. All right, we have Betty Kerr on the line, the Federal Deposit Insurance Corporation, of course, Wisconsin Native Loan Fund. We've got the team always supporting us. Welcome, everybody. Okay, yes, I'll go. Thank you so much for being here. Credit Builders Alliance. We have quite a few folks joining us from across the country, so we're very glad you are here, and again, welcome. Okay, guys, I have to ask you this question. Hand over your heart. Who is wearing flannel pajama bottoms right now at this very moment? Anybody out there wearing? Okay, we've got one hand raised. I too am raising my hand in solidarity. They may not be flannel pajamas, but they are yoga pants, and I know that they're very comfortable. We are all business on the top, guys. Oweesta, there's no quitting us. We have been working more than ever. Being in quarantine, we've been rolling out our webinars as much as we possibly can. And so I'm okay with my yoga pants on the bottom. We have quite a few hands going up. I appreciate your honesty, and thanks again. All right. So good afternoon again, everyone. My name is Tawny Wilson, and I'm a programs officer here at First Nations Oweesta. I will be facilitating this webinar today. And today we will be discussing how several of our CDFIs across Indian country have battened down those hatches and developed loan restructuring processes that we will be sharing with all of you today. We have an amazing panel here representing some of our best Native CDFIs that are operating today, and we couldn't be more grateful to our esteemed panel for joining us and being a part of this webinar. So as our panelists today, we have the amazing Miss Florence Ludka. She is actually our very own Chief Financial Officer, or CFO, at First Nations Oweesta. Flo has been rolling out webinars when it comes to financial management. There is such a need right now. She has been, I think I tease her, it's like she's on a webinar every week. And so I asked her, Flo, give me a picture we haven't seen yet. And this is actually Flo at her finest, out on her kayak with her little fur baby and doing her thing outdoors. Deep in her heart, that's where she would be, outdoors. She's an outdoors kind of lady. But Miss Flo is an enrolled member of the Sault Ste. Marie tribe of Chippewa Indians in Michigan. Again, she is our CFO here at First Nations Oweesta. She's responsible for the oversight and management of all finance and lending related activities and staff. We all know how much Flo loves being outdoors, like we said, with kayaking, hunting, fishing, horseback riding, or just being out in the woods, taking pictures of everything. We thank her for being with us today. She's always giving. That's kind of how she is. We also have the amazing Fern Orie with us today. Fern is an Oneida tribal member who is the founding executive director. Fern, correct me if I'm wrong, because I may say this wrong. Wigamig. I think I said that right, Fern. I don't know. So she was the founding executive director with 17 years working in Native communities and housing, community development, including land management, and operating a tribal housing authority. And currently she is the executive director of the Wisconsin Native Loan Fund. Thank you for being with us today, Fern. We have the amazing Russ Siegel with us today, the executive director of the Sequoyah Fund. He's been there for, gosh, I think since 2009. Prior to joining the Sequoyah Fund, he served as a small business center director at Southwestern Community College for 12 years. And prior to that, he owned a successful packaging and shipping company that specialized in the transportation of high-value art, electronics, and musical instruments. Russ manages all of Sequoyah Fund's operations and is charged with the overall financial health of the organization. Very glad to have him here. And last but definitely not least, we have the amazing Kristin Steinbach, is the director of lending, I should say, at Forbans Community Fund, and she manages the revolving loan fund program that provides loan capital to support private business development. She's a native to the area, grew up in South Dakota, I have to say, woo, 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 too, Kristen. I too grew up in South Dakota. She currently lives in Dupree, a small town west of Eagle Butte, out there in Cheyenne River. She enjoys working with all of the clients at Forbans, especially the youth. I have to agree, Miss Kristen, my heart is tied there as well. In her free time, Kristen enjoys painting and horseback riding, and I'm pretty sure after this is all over and we have a cure, we might find Kristen and Flo out there hanging out together once it's okay to do so. They have a lot in common. All right, so now without further ado, guys, we're gonna turn this over to our panel discussion. So unlike most webinars you've probably been on this week, and if you're anything like me, you're up to probably 7 this week, we are gonna go right into a panel discussion. And so we can just talk about some loan restructuring processes that our CDFIs have developed and really get into that there. So we wanna start off by defining what is loan restructuring. Loan restructuring is used when a borrower is under financial distress that it prevents timely repayment on a loan. It can take several different forms, but at its core, it is simply the process of changing the terms of an existing loan, typically in order to make it easier for the borrower to pay back some or all of the debt. So in simple terms, that's what loan restructuring is. Okay, so turning it over to our panel here, we want to we'll go ahead and start off with Russ, if that's okay. And Russ, if you could just walk us through these 3 questions about your organization. What is the process for loan restructuring at the Sequoyah Fund? What does the restructuring look like for you all, like the terms and etc.? And could you share an example of the restructuring that you're doing right now?
Sure, thanks. First, I remember sitting in a hotel room in Las Vegas during the Res conference, and I'd been on airplanes and been through airports on the way out there, and had heard about this and didn't really see anybody wearing masks, didn't see anybody panicking, and nobody at the Res conference. There were thousands of us there. Nobody seemed to even pay any attention. And on March 2nd, I'm sitting in the room watching the news, and I thought, we've got to get started on this, because even if the disease doesn't get us, the panic will. And so I reached out to our board at that time and said, we've got to start formulating a plan to deal with these. And I heard Kristen say earlier that their primary objective was, you got to preserve that current portfolio. And that was our immediate thought, was how do we keep our portfolio healthy? How do we help these folks through this, whatever this looks like? And essentially, how do we take Sequoyah Fund off of their to-do list for a while? Because they're going to have a lot of things on their plate. They're going to have a lot of things to worry about. And so our board got together, and we just decided that we were going to have a policy of a no questions asked 120-day payment deferment. If people are within 60 days of being current with us, we're going to give them a little wiggle room. So if they were no more than 60 days past due, they get a freebie. We're going to give them 120 days of not even thinking about Sequoyah Fund. And we talked with our legal counsel. A lot of folks at that time were talking about just turning off payments. And you heard this on the news that people wanted banks to just stop the payments. So we talked with our legal counsel, and he said, you have contracts in place. You can't just unilaterally stop people's payments, because what's going to happen is in a few years, they're going to come up to the end of their term and say, oh, I thought I was finished next month, and it turns out I've got 3 or 4 more payments. Why is that? Because people have short memories. So we decided that what we will do is not just turning off the payments or an extended payment holiday, but we do loan modifications. We actually go in and do a modification of the note for every single account, and we make them request it. The reason we want them to request it is that starts the timer, that starts the process, and we immediately had some folks, and turns out these were our best prepared borrowers. These were the people who were already strong going into this. They had good bookkeeping systems, they had good numbers, good processes, and we knew that we couldn't be face-to-face with people. So here it is in a nutshell. We put everything online. Everything gets processed through our website now. We use WUFO. WUFOO is our favorite form app. We've used it for years, and I love it because the people who invented it couldn't come up with a name, but they loved Foo Fighters and Wu-Tang Clan, and so they just put that all together, and that became the name of the company. So we use WUFO to do the forms, and a copy of a very simple loan modification request form comes in. I get a copy, and our account manager gets a copy. When I get a copy, I then create a task in Asana. I know that Flo's a big Asana fan, and you guys at Oweesta use Asana. It's a great project management, task management platform. And the reason I create a task in Asana is so that as he's dealing with this avalanche of requests, I'm able to keep up with it and check in with him to make sure that nothing falls through the cracks. So when he processes that request, he creates a modification of the note, a new amortization schedule. We send it off to the client to be signed with DocuSign. Again, completely contactless. We don't want them to have to even go to see a notary. We don't want them to have to talk to anybody to get this done. When it comes back to Dorian, he closes everything out. marks it as complete, and asana. That way nothing falls through the cracks. And so we created a very tight process for this. If someone has real estate as security on their loan, it goes from us to our attorney. What we want to make sure is that if we're backing somebody's payment term up 4 months, we don't want to go past the end of their deed of trust, because then we've got an unsecured loan. So it is a very tight process. I ask Dorian almost every day, do you need any help? And he has this flow now where he's working through everything, and he's got this process down to a science. But the bottom line, it was no questions asked. Now, if they were more than 60 days past due, going into this, the deal is that we're not going to give them relief, but we're also not going to pursue them. We're not going to start collection action. It means that we're going to have some difficult conversations when all of this is over. And we've had several people call and say, well, why can't you give me 3 or 4 months relief? Well, you took 3 or 4 months relief before this ever started. You didn't pay us. And so we can't reward you for that, but we're not going to punish you either. We're just going to have a very difficult conversation when this is over. So what does this look like? Again, the board just approved us to do these no questions asked loan modifications. The early requests that we got were very healthy. And that's one of the things that we looked at going into this. We knew that the first people to ask us were also going to be the first people to apply for the PPP loan, the EIDL loan. They were going to be the first people to go for the SBA programs because they were ready. They had good systems in place. One of the examples, you wanted an example. We have a 24-hour health center. They do free weights, they do Nautilus machines, they did spin classes. I mean, the whole 9 yards. And we had funded them from the earliest days, and we'd help them put in their 24-hour security system and access system, and they were just, everything was running like clockwork. And she contacted us and said, I don't think I need help now because I think I can weather this storm, but I want to make sure that you guys are ready for me if I do need you. The very next day, everything was shut down. Her business was forced to close. And so she contacted us, and we were able to turn this loan modification around in about 24 hours. Got her all of her paperwork. And that, again, Sequoyah Fund is now one thing she doesn't have to think about. We are very tourist driven, as I'm sure most of you are. That is a huge, huge part of our economy. I would say probably better than 80% of our local GDP is in tourism. All the hotels, the restaurants, the attractions, they've been shut down since November. Here in Western North Carolina, one of the big things to do in October is to come and watch the leaves turn. Never have we been so fascinated with things dying until they turn red and yellow and gold and everything. But when they shut down in November, they had no activity. So we couldn't look at the last 30 days, 60 days, 90 days. We had to look at last year's performance to see what they needed. We did, in the middle of the stream, we changed horses on some of the new money that we're lending because we saw what the SBA was doing wasn't working for a lot of people. So we modified that. And I think the biggest thing that I would put right in here before I turn it over is that our board made calls to all of our clients. We thought it was really important for everybody to hear Sequoyah Fund's voice. And we separated up the list. We gave everybody about 8 or 9 names. We took out some of the loans that we knew wouldn't qualify. Some people are paying through per capita and so forth. So they didn't get a huge list. But just hearing people say, I'm from Sequoyah Fund, what can we do? Here's how we can help you. What do you need from us? Was comforting to people. And so weeks later, I would get a call to my number asking for Tanya. or asking for Ray. And I'm like, wait a minute, why are these people? Oh yeah, it's because that was the board member who called you. But they really appreciated that.
Wow, Russ. It sounds like you have a really amazing an interactive board who deeply cares about the community. And I think that says so much about the work that you're doing out there. So thank you so much for sharing that, Russ. Okay, Kristen, can you talk about forebands and what your process was for restructuring?
Okay, well, at first, we waited to see kind of what would happen, because we're so rural that sometimes what's happening in North Carolina isn't going to be the same for us. So we were waiting to see like what the impact would be on our businesses. And we did have, a couple of our businesses, like with Russ, that were pretty proactive and calling. For like one specific example is I have a gal, as soon as the schools were shut down, she runs a physical therapy. She goes into the schools, so she contacts through them. Schools were shut down. She had enough money to pay herself through May, but the summertime, like the contracts that she would have got in May, she wasn't going to have any money during the summer. So she was one that we were like, okay, well, we're just going to modify. We did modifications, not restructures, because we were only pushing out the loan 3 months. So I had a couple filter through, and then suddenly, it was like everybody, then we decided within about a week into it that, okay, we need to do a blanket modifications for everybody, because the most random businesses, like we have a septic tank pumping business, he was affected because he didn't know, if he wasn't up to code with, hazmat or what all they need, like if this virus was able to go through the septic systems and somehow infect him, or his child has a diabetes, like if it would affect him that way. So things that like I just didn't even think of, these service businesses that aren't even actually in contact with other people being affected by. So that we decided to do a blanket. And what we did was, if you were one payment behind, so about what's like Russ, one payment behind is 30 days. You can be not more than 2 behind, so that would be 60 days delinquent. If you're more than 2, then that's a whole nother ball of, that's a troubled debt restructure. It's going to be a real hard restructure, like looking at your financials and everything. These COVID ones, though, just loan modifications, we have let them miss 90 days, so April, May, and June. And we're just going to have to reassess. It's kind of like a ongoing, we're just trying to be super nimble. And if they aren't able to reopen, if it's a restaurant, it's not able to reopen, we're just going to have to extend the modification. If we do have to extend the modification, so what I did was I did have to go in and redo the terms, because I didn't want, at the end of the loan to have, a 20-year loan, have them say, well, why am I 6 months out? And it's like, well, remember back whenever we had this crisis. Or if like forbearance has completely different staff, you want someone, make sure that somebody remembers that we actually changed your maturity date on this loan. So right now, like I said, we just did 90 days of no payments, just pushed everybody out, had them all. We did DocuSign with the loan modifications. We did have every business complete a survey, though, because we really wanted to grab information while we had a captive audience of how many days of operating cash do you have on hand? How many number of employees do you currently have right now? Because a lot of times we can't get that information from our businesses. Not all the time, but sometimes it can be kind of hard. So we had them complete the survey, and then we sent out I sent out modification agreements, got everything signed. Once I had the signed agreement, redid the loan in our software, and then started new. I had to redo it. Take a copy of, you keep copies of modification agreements. That's basically your new loan promissory note with everything in it. And we're just kind of, right now it's the middle of May. Things haven't really changed. So I'm just kind of waiting to see how many, if we're going to go in July, make people or have them businesses request deferrals. If it comes to that, I'm not really sure if we've made a decision what we're going to do. Because 3 months really in the term on a 10-year loan isn't too much. But we didn't want to go through and say that we've restructured every single loan in here, because that's not good. To have a bunch of restructured loans in your portfolio, right? Like, so we wanted to make sure that, we were saying these are just simply little modifications, tiny modifications in the grand scheme of our portfolio. They're not troubled debt restructures, which, if somebody, so to talk about, like, say you had a business that was delinquent before, then that would be one that would go in like, okay, so we would work with you right now, but this is going to be a troubled debt restructure. We need to look at all your financials and basically see like what wasn't working before, and have that tough conversation of, is this really working? You know, sometimes you need, the best solution is to exit the business if you're not able to make, you know, your payment for your business. So did I cover everything? I think I did. Sorry, kind of rambled there, but yeah.
No, you absolutely covered it all. Thank you so much, Kristen. Yeah, and it just goes to show how every organization, and I think you touched on that too, depending on where you're located. I mean, there's so many factors that go into the need and what's happening, what time frames things may be happening. So we appreciate you sharing that with us. All right, Miss Fern, let's turn it on over to you.
Hi, everyone. Those are two tough acts to follow, I can tell you that. So we, just like Russ and Kristen mentioned, we're trying to be proactive once this all started. And obviously that portfolio maintenance and preserving people's payments and not having them fall behind was of paramount importance right off the bat, along with looking at ways that we can help our borrowers to maintain payments and really walk through this crisis alongside them and be proactive and a resource to them. One of the things we did as well is the loan deferral payments. We put in a caveat that we could do up to 90 days of loan deferrals, just like Kristen mentioned. And everything's really being handled on a case-by-case basis. We have a portfolio that's mixed between housing loans, consumer loans, and business loans. And you're right, Tawny, everything is different based on everything from location to type of loan, et cetera. You know, every state has a different climate as well. We've had some wonderful programs that came through the state that we've been able to work with our borrowers and help them access emergency funds through the state. So that's been part of this whole being able to preserve people's ability to pay their loans and have working capital, things of that nature. Our actual loan deferrals, we can do up to 90 days. As we go through this crisis, we can look at if we need to extend that. I also have that same notion where we're looking at borrowers, where they are when we started this, were they, you know, current with their loan, were they having issues? Everything is being looked at individually and holistically, of course, like we all do as CDFIs, and really trying to help the borrower become a successful borrower and really build their credit and increase their access to resources and even their own debt to income ratios, et cetera. We've done a couple of restructuring as far as people that have had the need, because what we did is we put the caveat on the deferrals that they have to show that there's been a hardship. We've obviously had clients are calling us saying, can we stop paying on our loan because of the crisis? And then it's like, okay, well, do you still have a job? Did your income change? Some of the people that are calling, believe it or not, have not had a change in income. And so to me, it's one of those where, well, why would we change this right now? You're not experiencing any kind of income change. So if you do have that problem, obviously we're here for you. But, you know, people definitely try to take advantage of certain things, and we understand that, but we've been ready for that as well. And that's why we put these certain things in place to make sure that the people that really need it the most are the ones that are obviously accessing loan deferrals and restructuring. Some of the examples of this have been, we've got some small businesses on a rural reservation, northern Wisconsin. They weren't able to access some of these state funds, and their businesses definitely shut down. So we definitely have them on a deferral basis. One thing that we did, I don't know if it was mentioned, some of the gory details of lending, of course, we are offering that the deferrals come with a interest-only payment, so there's not a break in actually that flow of whether it's an automatic loan payment process, just so that the client is used to still making that monthly or biweekly payment, but it's just interest only. And obviously, if they're not able to come up with even the interest portion, we can definitely work with that as well and have no payments whatsoever. But it helps them stay current in that fashion. it has a little bit of money going towards the loan to pay the interest, and there's no interruption in that cycle of having automatic payments or payments being mailed to us, et cetera. So I think that's helping to preserve both the client and the CDFI as far as process and this whole loan deferral structure. Our board has been very supportive of this, and you know, we just wanted to be ahead of the game as much as possible. Like Russ mentioned, I was there with you at Res, Russ. It was crazy, right? A week later, the whole Las Vegas is shut down, and thinking, oh my gosh, what is this going to do for our entire industry? All of our clients that are already, you know, walking the line on trying to develop credit and make ends meet. That was the big piece to me. It's like, okay, immediately, how are we going to make sure that people don't fall behind? And, you know, luckily we haven't had a lot yet, but I feel like as time goes by, unemployment, all these issues where, you know, there's so many factors to what's going to like fall through the cracks, whether it's funding or different things to that nature. I feel like we're all just kind of holding our breath and being as prepared as we can with programs and products, and just ears to the ground and being aware of what's going to come to pass, and to be ready with as many possible solutions and resources as possible.
Absolutely, Fern. And what I'm really noticing a theme with all three of you right now is being very proactive. You have all taken those steps, you know, in the very beginning to be proactive. I love that you get the board involved, and even to have the board reaching out, calling customers, that is so huge. It just goes to show that this industry, I've worked in the nonprofit sector before, and coming into the CDFI industry was just like a breath of fresh air, because what I realized is that it's such a very close-knit industry, and so many people that are working here care absolutely with their hearts. And I think Andy Gordon said it best once. He said that CDFIs are like banks with hearts, right? Funding with hearts, financiers with hearts. And I see that in each and every single one of you on this call today. So that's just a little observation. Okay, and Miss Flo, if you could just walk us through the Oweesta loan restructuring process. We saved you for the last on this one. Oh, you're on mute, my dear.
Well, thank you, Tani, and hi, everyone. And like Fern having 2 great acts to follow, I guess I have 3 great acts to follow. And Tani, could you please advance the slides? I do have a couple of slides that walks through our process. So what we did, the first thing we did is we met as an executive team to decide an operational plan in light of the COVID-19 pandemic and everything that was happening. So one of the first things we did is we met with all of our loan clients to get a sense of, number one, their portfolio status, what their needs were, and basically asked them just a point blank question, like what can Oweesta do to help you, you know, during this time. So we, at the same time as kind of reaching out to all of our clients and having those meetings with them, we were also reaching out to our funders to see if they would be willing to modify any of the terms for us on our debt capital that we had, because that would really, we would be able to do on our end would really dictate what we were able to do for Native CDFIs in our loan portfolio. So we basically came up with, based on our meetings with our loan clients, we kind of went with the consensus, and everybody was asking for, you know, lower interest deferments, things like that. Everybody needed some help of some sort. So what we did is we put together a couple of different options, and then we analyzed the cost of each of those options and those effects not only on our loan portfolio, but also on our balance sheet. And so then we took those different scenarios and we mocked up different balance sheets showing the results of those different scenarios on the financial outcome in the end. So one thing we were really, one thing we were keeping in note this whole time, we wanted to help our Native CDFIs because we knew that by helping our Native CDFIs, they were in turn helping, you know, boots on the ground people in our Native communities. So we definitely knew we wanted to do that, but we also knew that we had to preserve Oweesta and our assets. And we wanted to be able to position ourselves not only for future funding, but also our current investors. We wanted to have some sense of, you know, the effect overall on Oweesta and how we would meet those cash flow needs and meet our operational expenses as well. So we ran through a bunch of those different things. We mocked up the scenarios. We did balance sheet projections out to 5 years out, actually, of what this would mean. So we really had a real thoughtful process behind our restructuring process. And I think we can go on to the next slide, Tani.
Okay.
And basically what we came up with is a two-phase process, a response and a recovery. So our response was we amended all of the loans in our portfolio and we offered interest forgiveness to all of our loan clients through December 31st, 2020 of this year. And with that being said, interest would not, and this wasn't interest deferment, this was actually an interest forgiveness. So it wasn't accruing on the back end where it would be charged later on. It's a true interest forgiveness program where there will be no interest charged through the end of this calendar year. And then there will be no payments of any kind, principal or interest, required until April 30th of 2021. So that was our response, our initial response. So kind of just trying to you know, be proactive and kind of just address our immediate concerns. And so then the second phase of ours is we're calling this recovery. And so effective July 1st, we are going to be offering early renewals for all of our loans in our revolving loan portfolio. And by doing that, we'll be extending the terms on those current loans and in some cases, able to lower the interest rates as well. So we figured that it would be just Oweesta going through this whole recovery after the pandemic is hopefully over, but all of our Native CDFIs will also be going through a recovery period too. So we felt that this would be best suited to not only, you know, help us, but help our Native CDFIs, not just 6 months down the road when their interest forgiveness runs out, but also 12, 24, 36 months and beyond, you know, into the future too, by offering these early renewals with extended terms and the lower interest rates. So that was our, that was the way we kind of handled this. And then our next slide is, oh, okay, I thought I had one more in there, but I guess not. So we, you know, by doing this, we're hoping to save our loan portfolio. We, you know, by giving relief to our Native CDFIs, hopefully none of our loans will go delinquent. And we're also kind of getting pretty creative. We're not calling these, you know, debt restructures or anything like that. We're just going to call them early renewals, and we're going to, nobody will ever know the difference who looks at our portfolio from, you know, what that it really was in response to COVID-19 or anything like that. So, and that also helps with some of the, we're going to do, you know, complete underwriting when we do these early renewals. So that we underwritten, it will help us get a sense of where each of our loan clients' loan portfolios stand at that point as well. And that will help us for planning into the future. You know, right now we have our interest forgiveness till December 31st, but when we start to do these renewals and we get a chance to look at some of the portfolios of our loan clients, we might find, oh, we need to extend that program, or we need to modify it this way, and we need to change it this way. This is what's happening out there in the field. So we do have, you know, we do have flexibility, and we just did a kind of a blanket approach. Like I said, when we met with each of our loan clients, we asked the questions, we got the feedback, and we took what we thought would work, you know, like the best for everyone. So we weren't, we offer the same thing to everybody. And we've actually had a really good response as of, I think as of today, Those amendment forms have all been sent out, and I think we have 98% of them returned. So pretty much every single one of the loans has been amended at this point. And the early renewal period, we're going to start that at the beginning of our new fiscal year, which is July 1. And we will have all of those completed by December 31st. So we'll have all of the early renewals done before the interest starts to accrue again on January 1st.
Oh, wow. Fantastic, Flo. And I'm so grateful to work for an organization that really leads the charge and being that funder with a heart. And I think Oweesta just exudes that over and over again. So thank you so much for that, Ms. Flo. All right, so back to the panel. We have another set of questions for y'all. First question is, how do you know who is a good candidate for loan restructuring? And what have been some of your challenges you are experiencing during this time? Kristen, if it's okay with you, we'll go ahead and start with you.
Yep. It's tough to know who is a good candidate, because a lot of times if you have a smaller loan portfolio, you just know, like, well, I just know that'll work for them. But to blanket it down so that anybody can use it, it's really just looking at, like, is this a short-term cash flow challenge? Like, is it an emergency? Did they get delayed receivables? Like, say a contractor that didn't get he wasn't paid on time, something like that. That's kind of an easy fix where we can just do a short-term payment plan, like, oh, yep, we'll just catch you up in 2 months, then you'll be back on track, something simple like that. Whereas doing a permanent loan modification restructure, like a restructure, we've got to have like a permanent change in their cash flow, fire, loss of assets, like something major, or the whole market shifts, like, oh, a restaurant shutting down forever, like not being able to have the clients that you did, or the tourism industry, if you're shut down for a year, or you have no tourists coming in, then you're going to need to do a permanent loan modification because everything has to change. So it's just kind of hard to tell if they were delinquent. I guess the hardest thing that I felt with the restructuring work that we've done is having the clients that were previously delinquent. That's been the toughest, because we can't really help them too much because they were already delinquent. We're kind of even though our process of like foreclosure and that type of stuff has stopped for a little while, we still are, they're still heading down that path. But yeah, really just looking at, like, okay, what is this, a short-term cash problem, or is this a bigger problem? Like for me, looking at the COVID right now, short-term, like less than 6 months is pretty short-term. But if it's going to extend farther than that, then we're going to need to start looking at these long-term loan modifications. And if it comes to that, then the loan will have to be basically underwritten, renewed, like Flo said. Like, we'll have to go through and kind of relook at everything and then say, like, okay, are these payments going to match what their cash flow is going to be with where we're living at now, or not, So that's kind of how I foresee us going forward. But we've always, even pre-COVID, it's always been looking at cash, like short-term. Is this just a short-term crisis or a long-term crisis? So that's kind of what you need to look at your borrowers, or their businesses specifically. And I didn't touch on we also have consumer and home mortgage loans before. We luckily, most of our consumers have been able to stay paid. So we haven't had to do really anything with our consumer loans. And the home mortgages, we don't really have anybody that works for, our portfolio is small right now. They all have like government employment. So it's mostly been our poor businesses that are just that we're trying to save. So, but yeah, that's where I would say, like, if looking at the candidate, you really just have to look at the cash flow and is it going to work, or are you just going to put a Band-Aid on a bad situation? Are you just Band-Aiding it? Because you don't want to start restructuring debt just to keep them not from being delinquent. Like, you just can't do that. So that's my 2 cents on that.
Oh, absolutely. Okay, Fern, what about you?
I agree 100%, Kristen, about not putting a Band-Aid on a situation that's just going to keep going south. I think that's one of the keys to making sure that we are doing restructures and deferrals where it's in the best interest of the borrower, that they are going to be able to maintain those payments, that it's not going to be just a temporary hold for something that's just going to keep getting more delinquent. As I mentioned before, a lot of this is based on the borrower's ability to pay the loan. If there's been a change in income, obviously we want to work with them and maintain that ability to pay the loan. Some people, they haven't had any changes and they're just trying to have some extra cash flow. We understand that, but why fix something that's not broken right now? We're also trying to be poised and ready to be able to offer that to borrowers as things change, since this is such a fluid crisis we're dealing with. And as Kristen mentioned, the business clients are usually the hardest hit right now that we've seen. Luckily, most of our consumer and housing borrowers have been maintaining. Here in Wisconsin, a lot of the tribes have gaming facilities. All of those employees, luckily, are being covered through unemployment, or the tribes themselves are covering their wages, thank goodness. As that deteriorates, as we anticipate, that's when we want to be on the ready and able to really address payments and restructuring and helping our borrowers through that period of time. Also maintaining our own organization's infrastructure and portfolio, et cetera, even our own employment. One of the things we've done to address these challenges and be prepared for all of that is we actually hired a new staff person. I think she's on the phone with us right now, Betty Kerr, and she is our grants manager and collections officer. And that was an anticipation of really having a dedicated person work with clients and have them be aware of resources and opportunities and programs to help them, especially our small business owners, so that they can access as many resources as possible with our help to help maintain their business and help maintain a good loan with us, and really just have that organizational infrastructure within our own CDFI that we're building our capacity to really handle everything that's coming down the pike for all of us in our industry. So I think that's been a challenge that we were able to really mitigate with adding staff at this time, which is kind of scary, but at the same time desperately needed. I think our board's been awesome in supporting all of that. And I think ultimately it's just all about really trying to keep a pulse on our target markets and their needs and what resources are out there, and connecting our clients to those and using our CDFI as the medium to do that.
Yes, absolutely, Fern. And welcome to Betty. It's so good to have her in this industry. And I know what a hardworking crew you are, Fern. So to have her be a part of your team, I'm so excited for you all.
Oh, we are so excited.
Yeah. Okay, over to you, Miss Flo. If you can talk us through, how do you know who is a good candidate for loan restructuring?
Yeah, so for Oweesta, as an intermediary and not a direct lender, it's a little bit different. And so that's why we chose to have our meetings with all of our loan clients, so we could kind of firsthand knowledge of, what they were experiencing once the pandemic hit and things started to shut down. So basically, for us, it was determined that everyone in our loan portfolio was a good candidate. And the reason why is because it was expressed to us that, the biggest thing was that our Native CDFIs needed to have the flexibility to be able to do the restructuring and the deferment on their end. And without cooperation from us as a lender for the debt capital that they were lending out, without cooperation from us, it would have been a little bit hard for our Native CDFIs to be able to offer the types of restructuring and things like that they needed to during this pandemic. So that's how we, that's how we determined it. And it was basically just on feedback, from all of our Native CDFIs in our portfolio. And we kind of addressed it that way. As far as challenges, we've had a couple. One is we are literally onboarding an entirely new lending team, except for myself, during this pandemic. So that has definitely been challenging, but we're working through it. And then I think the next biggest challenge was, with interest forgiveness, that was quite a bit of money on Oweesta's that we had to that we had to kind of compensate for or figure out how we were going to, do without that money coming in. In addition to that, we had to raise our loan loss reserve. So we had to kind of downgrade our portfolio to accommodate that. So that was additional expenses there. So I would say our biggest challenge was figuring out, okay, how are we going to pay for this? We're losing revenue and we have to make a huge expense, a pretty big expense in order to raise our loan loss reserve to a more a level that was more conducive to what was happening throughout the country, the shutdowns, especially impacting our small businesses. We already know that small business, is 50% of our loan portfolio. It's 50% of our loan clients' portfolios combined. So, so we knew it was a big hit, and we kind of needed to protect ourselves not only now but going forward. So we had to make some, tough decisions as far as cuts go operationally. Some of those were payroll, and there's, we went to essential expenses only policy. We stopped staff development expenses. We stopped travel expenses. Of course, no one's traveling right now anyway, but even if travel does open up, it will be, essential travel only. So we've made some tough internal decisions in order to be able to handle some of these expenditures and loss of income. So not only we're figuring a couple of things, not only are we, losing our interest income from now to the end of December, but we're also, there's going to be other income loss. There's going to be, contract revenue losses. There's going to be, the other thing is I have a really robust investment policy where I take our idle cash and I do investment with it. And we were depending on a certain X amount of income coming from that in every year. That now I'm not able to get a return on any of our idle cash. So that's another factor of losing money. So that I would say just trying to figure out how we're going to recoup some of these expenditures and loss of income is definitely our biggest challenge at the moment.
Thank you, Flo. That was very helpful. And how about you, Russ? How would you answer these questions?
Well, I definitely feel Flo's pain. We had just moved about $500,000 idle cash out of our RLF into an investment fund. And after the physical illness went away and I realized that it will get better, I just kind of moved past that. There's nothing I can do about it at this point.
Yeah.
And I'm just going to, ditto what Kristen and Fern have said about if they were healthy coming into this, they were a pretty good risk in terms of modifying the loans. We look at, cash flow. Did they have a healthy customer base? Did they have solid business practices? Those were the things that we were looking at. And in a way, the tribe made it pretty easy for us to make these decisions because we do have so many restaurants, hotels, and attractions, even service businesses. The tribe made the decision to shut the boundary down. They put checkpoints up at all of the ingress and egress points. You were either an essential employee who had to be there, or you had an address. We even had enrolled members who live off the boundary who had trouble getting onto the boundary if they didn't have to be there for work because showing an enrollment card was not enough. They had to show a driver's license that showed an address on the boundary. And so when they made the decision to shut that down, we just had to look at all the businesses that would have had cash flow during this time, and that stopped. And like Fern said, we did have a lot of folks who, I guess out of just instinct, they jumped on the bandwagon and said, oh, there's money, I've got to go get money, or there's relief, I got to go get relief, even though my business hasn't been affected, even though my income has not been affected. And so we had some discussions with those folks, and what we talked about with the board was that, yeah, we want to give 120 days relief, but the 120 days doesn't have to start right now. So if we have somebody who's not going to feel the pinch for another 6 months, and yes, 6 months is not unheard of. We're thinking 18 to 24 months before we're really back on track after this. we can do that 120 days in the future. We also have a substantial portion of our portfolio in housing rehab loans. One of the challenges that we've had in that portfolio is a lot of those folks, we allow them to pay out of their per capita. Every 6 months, we take 6 months worth of their payments out of the per cap. We garnish that, and it's really easy. It's easy for them. It's easy for us. But the problem is that everybody started to count on that money. Because the per capita is calculated 6 months in arrears, all that money was sitting there in December. So June's per cap is going to be sweet. December is going to be terrible. So we have people who are out of work. They realize that they don't have the income. And so they were reaching out to us saying, hey, can I get some relief on my June per capita? And the challenge for us was just to have difficult conversations. So for them, we were saying, look, let's leave June where it is. Because June's per capita, you've already planned for it. We've planned for it. But December is going to be where we might have to give you some relief. We're going to have to do these housing loan deferments in December and even next June. So that's a challenge for us. Another challenge was just the tough love aspect of our commercial portfolio. Having to talk to people and say, look, you've done this to yourself. When you take money and you stuff it under your mattress and you say, look, I'm going to get one over on the tribe. I'm going to get one over on Uncle Sam. I'm going to keep this money for me. Then you don't get to take advantage of any of the relief that come from those sources. And just telling people, look, we can do this for you, but now you're going to have to act like a business. You can't just run this like a hobby and you've bought yourself a job. So the big challenge that we've had, and we put Hope Husky in charge of that. I don't know if Hope is on this call. We call her the hammer. And so we put Hope in charge of having some of those. She and I have those discussions with the clients because it's not fun. And they say, well, I've been in business 20 years. Yeah, well, you've been around 20 years, but you've not been running this like a business. And now it's time to step up. So if you want us to do this for you, here's what you've got to do for us. We've got to see some solid bookkeeping. We've got to see some real numbers out of it. We got to see you reconciling that bank account every month. Just some simple things. So yeah, I mean, those challenges, and I know that those are the least of some of the challenges we're going to face going forward. But trying to balance compassion and being everybody's go-to organization when they're in trouble and still have to give that spanking when it is just not fun. It's tough. It's tough for all of us.
Yeah, absolutely. And it sounds like so many of us are having these challenging conversations, Russ, but I can only imagine when they come out of there, they probably feel like almost a relief, to know that Sequoyah's there. You guys are amazing. You're helpful, but you've got to have some kind of, policies in place to a certain extent. So, all right. I know we've got another really good panel question here. What emergency loan products are you offering or developing at this time? Fern, can you start us off with this question?
Certainly. Along with being proactive about protecting our existing portfolio, we also wanted to be very mindful and on the ready to come up with some products that are going to assist our borrowers and potential borrowers during this crisis. We developed a consumer relief loan. The skinny on that is basically it's a loan up to $5,000 to help make ends meet for people that are experiencing a hardship. Definitely want collateral if at all possible, but it is possible to have a unsecured loan at a higher rate. These loan rates are between 6 and 15% based on collateral. And obviously we're trying to roll in closing costs. There still are origination fees and loan application fees, but we have them rolled into the loan, and also deferring those initial payments out. The first 90 days is interest only, just like we're structuring any deferrals, where we're going to have that set payment established to get that process going. and just have it interest only. Obviously, if somebody cannot afford that as well, we can waive those or defer those interest payments and roll that into starting the loan after the 90 days. And if it needs to be extended, we're able to be flexible on that as well. Another loan that we're doing to really be helpful with our business borrowers is to develop the same notion. This is in development phase right now. Is like a working capital relief loan for small businesses. Same notion. If businesses are in need of capital to make ends meet, we can go down that same process with closing costs rolled in, deferred interest, interest payments only, and just have everything as customized and resourceful to the borrower as possible so that we can be there with these kind of products during this crisis. And this is all, the consumer loan we just released, like I want to say last week officially. We're using our online lending platform through our website, through Otis, through that portal to take applications. We already have, I want to say like 20, 25 applications since Friday, which is crazy. And then the business one, we have a board meeting in July that we're going to have that prepared for their review and approval, and we look forward to rolling that out as well.
Wonderful. Thank you, Fern. Flo, do you want to jump in and just talk about Oweesta's emergency loan products at this time?
Sure. So we launched 2 products. One is a line of credit for our Native CDFIs, and that is lending capital line of credit, and also which kind of fits perfectly with short-term emergency loans that some of our Native CDFIs are doing. And then launched a working capital loan. So that is to help our Native CDFIs kind of get through this period if they need some working capital and need some operational expenses covered. It does not have to be used for lending. So it can basically be used for anything any of our Native CDFIs want to. And the response has been very good on both of those products. I think deployed $1 million here in the last couple of weeks. So, so getting that money, hopefully, back into our Native communities, but to provide some relief there. But those are the two loan products we have.
Wonderful, Flo. Thank you. What about you, Russ? Do you have any emergency loan products offering or developed at this time?
So as I mentioned earlier, we bumped our normal emergency lending cap from 5,000 to 25,000. And the only thing that we did different there was, and we went through all of our normal underwriting procedures. Every standard that we had before was in place for this. The only difference was that we waived some fees. We waived the origination fee, we waived the closing fee, we waived, well, pretty much all the fees, just to make this happen. Simultaneously, the tribe was sitting on a fund balance that was pretty hefty and healthy, and so they came together and put together a tribal stimulus package that was 2 phases. One was a levy rebate, so that from the beginning of the fiscal year, October 1, if your business paid into the tribal levy, depending on the amount of levy you paid, you could get a portion of that back. So the more you paid in, the smaller percentage you got back. But if you paid in a very small amount, you could get 100% of that back. And they contracted with Sequoyah Fund to handle that. That was easy. We did an application that they could apply for both parts of the stimulus in one application. Tribal Finance calculated their amount that they paid in. We did the math and we cut a check. The second phase of that was a Payroll Preservation package that sort of mirrored the SBA's PPP, but it was pretty simple. If you had over a certain level of payroll in the prior 90 days prior to the tribal closure, you could get a $10,000 payroll grant. As long as you used it for payroll, it's a grant. If you were under that, you got a $5,000 payroll grant. So we had people who were trying to game the system. They would come in and they would say, "Oh, I've got I've got 3 businesses and my payroll was $10,200. So I qualify for, well, no, it really wasn't. It was $8,000, but they weren't happy with us for actually going back and checking the homework, but we had to do that. We are responsible to the tribe for making sure the numbers are right and making sure everybody's doing what they're supposed to be doing with the money. So that was something, it took some time to do it, but the money moved out pretty quickly. In the meantime, North Carolina put together a $140 million package that is only being rolled out through CDFIs. It is us and 6 other CDFIs and community development corporations. There is a $50,000 loan cap, and it's roughly 2 months of last year's average monthly revenue up to $50,000. And each CDFI uses our own underwriting process, whatever that is. And we own that loan, this is really nice. It's really going to skew our percentages in terms of native versus non-native lending, but I'll address that here in just a second. And so one of the things that we're looking at with that is that we own that loan all the way through to pay off or to default, whatever termination status is. North Carolina, through the North Carolina Rural Center, is picking up any legal expenses if we have to foreclose on somebody. If we have expenses related to collateral recovery, they're covering those expenses. We get a 3% upfront fee and we get an 80-20 interest split. So big win for us. We like that. So I did hear, and I can't remember who said earlier, something that kind of triggered this. And with this bump to our balance sheet that is going to be non-native borrowing, our auditors put a paragraph in our audit this year, and Flo's going to be happy to hear this, that they put a COVID-19 paragraph into our audit that allows for variation, because they just said that they've got so many organizations like ours that are going to be so far out of the norm of what we normally do. And it's going to give us a little bit of a buffer next year when our numbers are out of sync, when we have higher default rates than normal, that this was not in the course of normal business. So if you're having an audit done and you're in the middle of that, see if your auditor will add that language to your audit. Because it is going to help you. And just like you may have, like Kristen said, you may have a different staff in 20 years. Lord, I hope we have a different staff in 20 years. We may have different auditors next year. And I know, in fact, I know there will be a different audit team. And if somebody has a short memory, or if they get hit in the head with a brick and they say they can't remember COVID-19, I want them to be able to say, this is why Sequoyah Fund's numbers look different. So yeah, challenges abound.
Wow, absolutely. Okay, and then what about you, Kristen?
We were a little bit short on loan funds anyways this year for deploying. So we didn't really have the budget to be able to develop an emergency loan. And we didn't feel the need, like when the government shut down at the beginning of 2019, we did an emergency loan then. So we've done them before. Default rate is high, like Russ said, usually. But really our area where we do our consumer lending is where we do emergency loans, and the businesses, there hasn't been that big of a need on the consumer side. The businesses, we pushed it, as many as we could to PPP EIDL to try to have them take advantage of that funding. They have better rates anyways than we do. And then we've been trying, we're trying to drum up grant money to do some equity injections into these guys so that it's not loan, because honestly, our businesses don't need more loans. They can't, they've got like 15 days of operating cash on hand. They can't handle another loan payment, so that really won't fix the problem. So we're trying to get the grant money that we're trying to get in there to help them. So, but right now we don't, working on it. So
yeah. All right. And last panel question. If you had one word of advice for your fellow Native CDFIs right now, what would it be? One word of advice. Miss Flo, do you want to take this one? Start us off. One word.
Sorry, I was on mute again. Courage.
Courage. Okay, Kristen.
Patience? I don't know.
Patience. Russ.
Communicate.
Communicate. And Fern.
Adaptability.
Ooh, absolutely. All important attributes that we need to have right now going through this time. And so I just want to say thank you guys so much. That was extremely helpful. We do want to open up the space for some questions, and I do apologize. I know we went a few minutes over, but do we have any questions out there? I know Russ has been answering questions as in the chat box as we've been going along. But do we have any other questions at all that anybody would like to ask? Can you guys hear me okay? Oh my gosh, why is that doing that? I froze up.
I don't, is everybody froze or is it just Tani?
Oh,
think
it
it's
was
just
just
Tani.
me, my dear.
Okay.
I'm so
All
sorry.
right. So I'll just kind of take